If you're a Canadian and you have no idea how to understand your personal taxes, don't worry, you're not alone. In fact, you're actually part of the majority, as unfortunately our education system here does not prioritize understanding finances and taxes. However, if you would like to better understand how your personal tax return is laid out, how your taxes are calculated, and what you can do to impact your taxes, then stick around because in this video, I'll be going through just that. Okay, so what we have here is a walkthrough of just a summary of a personal tax return in Canada. What you're seeing here is a 5-year comparative summary page here, which is something that we include in personal tax returns for our clients. If you don't receive this as part of your personal tax return package, you can request it of your accountant. It should be fairly straightforward to get. But what we really like about the 5-year comparative summary is you can see how things change year over year. And so what we're going to do here is just walk through the summary. Don't worry, we're not going to go through every line because that's going to be something that will probably cause your eyes to glaze over. I know it's like hyper tax there. The overall objective of what we're doing here is just to help you understand where things are located in your personal tax return, get a general sense of how things are calculated, and then know how you can impact your taxes in various ways. Okay. So there's kind of 4 sections that I want to bring your attention to, or sort of 4 steps. There's actually quite a few more sections in here, but 4 general steps that I think are helpful to understand in the calculation of your personal taxes. Okay, the first is the calculation of your total income. All right, then you have various deductions, which gets you down to what's called taxable income, which is the amount off of which your personal taxes are calculated. Then you have the calculation of what are called non-refundable tax credits, and then you have the calculation of your tax. And so we're going to go into each of these sections in a little bit more detail. Again, don't worry, not in hyper detail on all these lines, but just kind of highlighting some of the common ones that you might see on your personal tax return. So the first one here being employment income. Employment income will be if you have a job, right? You get a T4, you'll see that show up here. If you're of age and you collect old age security or CPP payments, you'll see that here, right? You got your pension here. If you have a spouse who has pension and you elect to split pension, then you will have that amount show up over there, right? If you have investment income, right? Oftentimes you'll see some taxable dividends, hopefully. You'll see investment income. You'll see some taxable capital gains if you sold off some of your investments, or if you had some other assets that you sold for which you had a capital gain. Sometimes you'll see other sitting there if you have investment income. If you have a business like a corporation that you are a shareholder in, then you'll also hopefully see some taxable dividends if it's profitable and generating dividends for you. If you have rental income, right? If you have any kind of real estate that you rent out, you have tenants, then the net amount of your rental income will be here. Okay, so it's not the total amount that you receive from your tenants over the course of the year. It's that minus all the relevant expenses that will net out to this amount. If you have self-employment income, okay, so say you don't, say you have a business on the side, or full-time you have a business and it's not incorporated, then the net amount of that business, the net income from it, will show up over here. Not the total amount of your sales, but the net after all your expenses. And so that will tally up to total income. So total income is all of your sources of income that you receive over the course of the year. Then we get down to what's called taxable income. And again, taxable income is the amount off of which your taxes are actually calculated. So you're not actually taxed on your total income. You're taxed on your taxable income. And so then the question is, well, how do you get down to that, right? How do you impact that? And so that's where we'll see some of these things, right? So if you have a job and you're contributing to a pension plan in your job, you'll see an amount there. This is where RSPs come into play. So if you've probably heard that if you contribute to RSPs, you can save on taxes. That's how this is done, okay? Because RSPs will show up here, which reduces your total income down to your taxable income, right? It will reduce that taxable income amount relative to your total income. If you have, say union dues or various dues through professional organizations that you have to pay, childcare expenses help with these things. If you have any eligible moving expenses, again, check with your accountant to make sure that if you have moving expenses, they would be something you can claim, because there are some rules around that. Let's see some other things. Carrying charges, okay? So if you, for example, have maybe you took out a loan to make some investments and you have somebody managing those investments, the interest on that loan you could put over here. Any investment management fees you can put over there. You can put your accounting fees over there if you have accounting fees to help you with investment income and the like. So that will get you to what's called net income. And then there's some other adjustments here which are a lot less common for most Canadians, but I'll just go through some of them here that will get you down to taxable income. So some things, might have some losses that are carried forward, which can be applied against the current year that you're doing here for taxes. There's also the Northern Residence deduction here. So if you live in a certain zone in Canada for which you can claim that deduction, then that amount would show up here. And so all of these amounts that would show up on these lines, okay, there's quite a few here. I think I mentioned childcare expenses, right? These all reduce your income, getting you to what's called taxable income. So taxable income is what, your taxes are actually calculated on. So then, now that we've determined our taxable income, and we'll see how taxes are calculated, okay? Actually, let's go there now. Now that we have our taxable income, I'm going to bring you to the T1 form. And don't worry, this is, we're not getting into the weeds here. I more just want to show you how your taxes are actually calculated, okay? And so there's this common perception, which is not correct, that if you make more money, that all of your money is going to be taxed at a higher rate. In Canada, that's not the case, okay? The way it works, we have something called a progressive tax system, which means as you make more money, you pay progressively higher amounts of tax. And so the way it works is this. We've calculated taxable income, as we saw from the 5-year comparative summary we were looking at just a minute ago. That gets you to your taxable income, right? Now, once you have your taxable income, it's going to be used to calculate your tax. And how is that done? You have these different tax brackets here, okay? The best way to think about tax brackets here is maybe think of them like buckets. And so if you have your taxable income, it's going to pour into this first bucket here. This first bucket is taxed at 15% at the federal level, okay? So you pay federal tax, so that's like Canadian-wide, nationwide. Then you also pay provincial personal tax, and this is actually quite similar to what happens here, just you'll have provincial rates instead of federal rates, okay? So you take your taxable income, it's going to pour into this first bucket here. This bucket is taxed at 15% at the federal rate, but it fills up at $55,867. And so say this number is $100,000, your taxable income, after all those deductions that we looked at. The taxable income pours into this bucket, it fills up at $55,867. So then the rest of that $100,000 will go into this bucket, which is now taxed at 20.5%, okay? And so, if you made $200,000, if your taxable income was $200,000, then you would have it pour into this bucket first, right? It fills up at $55,867, taxed at 15%. Once that fills up, it pours into this bucket and we'll fill it up, and it'll be taxed at 20.5%. This bucket fills up at $111,733. So if you have more than that, it will spill into this bucket, which is taxed at 26% at the federal level, etc. Okay, so that's how it works. So when you think of tax brackets, think of it as like tax buckets that fill up to a certain level. They are taxed at specific amounts, and as you make more, it will fill up the next bucket, then the next bucket, and each bucket is taxed at a progressively higher tax rate. Okay, so again, these are federal tax rates, and there are also provincial tax rates. So when you receive your personal tax return, depending on which province you live in, you'll see something very similar on the schedule related to your provincial taxes, where it takes your taxable income and then puts it into your provincial tax brackets, which have different thresholds and different percentages here at the provincial level, and that's to calculate your provincial tax, okay? So that's how your tax is calculated off of your taxable income. So let's go back to the 5-year comparative summary here. So we've calculated our total income, right? Then we've done the deductions to get us down to what's called taxable income. We've calculated the tax at the federal level in order to determine how much federal tax we would have to pay. Now we have something called non-refundable tax credits. What are those? Non-refundable tax credits are effectively tax credits that will reduce the taxes that we calculated over here. Okay? Oh, sorry, we kind of bounced back over there, but let's just kind of scroll down. At the end of the day, we had our taxable income, and then we calculated how much tax we had to pay from these different tax brackets. Okay, so we go back to the 5-year summary. We have our total taxable income, calculated out the taxes. Now these non-refundable tax credits, what they do is they reduce the amount of federal tax that was calculated. And so how is this calculated? Sorry, before I get there, let's talk about the term non-refundable tax credits. What does that mean? Non-refundable tax credits, they reduce your taxes, but they are not refundable to you if you don't fully use these tax credits, okay? So for example, say, let's go through this math first. So in order to calculate this out, you have a number of different items for which you can receive tax credits, okay? The first one is called the basic personal amount. This is available to everybody in Canada. This amount can be adjusted if you start to earn a certain amount of money at a pretty high level. For most Canadians, that's not the case. Some other common ones, if you're of age, you'll receive a credit there. If you have a spouse who doesn't fully utilize their basic personal amount, then part of theirs can transfer over to you. Okay, some other key ones, if you have a job like employment income, you're going to have EI and CPP that you pay. As you know, you have source deductions taken off of your check, and so those amounts will show up in here. If you are a volunteer firefighter or a search and rescue volunteer, you volunteer a certain amount of hours. At this time, it's 200 hours. That might change at some point. Then there's a credit there that's available to you. This Canada employment amount is an amount that's available to anybody with employment income, okay? And it's the credit typically maxes out, currently it's around $1,400 or so. It maxes out up to the amount that you've earned. So if you've earned up to $1,400, then you've got that credit. And then so if you've earned more, then that it just kind of stops at the amount that's available there. So that's one of the credits. Digital news subscription. So there's a digital news subscription credit that you have available to you. So if you have a digital news subscription, you can actually claim that as a tax credit. If you have the disability tax credit, okay, or you have a dependent who does, then those will show up over here. If you have student loan interest, you can claim that as credit. If you have tuition income, okay, then you can claim that here. If you have a child who has tuition income and they don't need to use all of their credits, they can transfer some your way over here up to a maximum, or there could be some credits transferred over from your spouse here, as well as medical. Okay, so medical expenses are something a lot of people don't necessarily think about, and so if you have medical expenses, dental expenses, optometry type expenses, a lot of eligible medical expenses. You can Google what. If you just search that in Google, eligible medical expenses, Canada, CRA, something like that, it'll bring you to a link and it'll just list out all of the types of medical expenses that you can claim. Okay, so those are all credits. So those tally up over here, and then it's multiplied by 15%. Okay, why 15%? So 15%, if you recall, when we looked at the tax brackets, that's the lowest marginal tax rate. Okay, that was the first bucket that funds went into. So everything calculates up to at that rate, and then that gives you an amount here. Those are your non-refundable tax credits over there. Okay. Then if you make donations, then there's a calculation which we won't get into here that will show up here as well, getting you your total non-refundable tax credits. Okay. Again, if you don't use these, right? Sorry, I just hit my microphone. If you don't use these amounts, then they're not refundable to you. So for example, if a person's taxes were $1,000 for the year, okay, and then they had non-refundable tax credits of $2,355.75, they wouldn't get the difference back. It's not refundable, so it's lost if not used. Okay, so having said that, some things carry forward, which we won't get into in this video here, but feel free to ask your accountant about those things. So from your total, your taxable income here, we calculated out the taxes, right? We looked at how that happens on with those different tax brackets. So that would show up here on your form. So say that amount was $5,000, right? Then your non-refundable tax credits from here would subtract off of that, okay? So we've calculated non-refundable tax credits here. So let's take a step back. We calculated total income. We calculated taxable income. Now we've calculated non-refundable tax credits. So the last step is calculating your taxes, right? So you have the amount calculated there. You subtract your non-refundable tax credits. Then you'll have different things here, such as dividend tax credits if you receive dividends. If you have foreign income, for example, then you'll have a credit there often if it's eligible. So you have different things that will come off, getting you to your net federal tax. Then you have CPP on self-employment income. So a lot of people are unaware of this, but if you have self-employment income, you pay CPP as every employee otherwise would. But then also as the employer of yourself, you have to pay the employer portion of CPP as well. Okay, so that's up here. Then you have your provincial tax. Okay, that's calculated here in a very similar way that the federal tax is calculated with those federal tax brackets that we looked at earlier. So I can see total tax payable. Now this number, total tax payable, this line here, 43500. I think it's very, very important that people understand the amount that's on that line. Okay, become familiar with the amount that's on that line, because what that represents is your total income tax for the year. The way we explain this to clients is, if we had to take a bag of money to the CRA every year in order to pay our taxes for the year, that's how much would be in your bag of money. Okay, but as you know, over the course of the year, you typically will have taxes withheld from payments that you receive, and so most people are just curious what their refund might be or what they have to pay at the end of the year. But this line here is your actual income tax number for the year. So I think it's very, very important that people become familiar with this number, and also that they see how it might change year over year. Okay, that's how you become a much more informed taxpayer, which I think is very, very important. So that's your total tax payable, but do you have to pay that amount? Well, yes, you do, but not necessarily at the time when your personal tax return is done, because you will have had income tax deducted, right, from your paychecks. If you have employment income, there's going to be various credits, which represent amounts that will reduce this total payable amount. Okay, so common ones, right, income tax deducted. That's going to often be the biggest one for most people with employment income. If you end up overpaying your CPP and EI, this is going to be very common if you have two jobs in the same year, because both jobs will be deducting CPP and EI, and so you may end up overpaying those amounts. There might be some other things here. Canada training credit, right? So if this is actually a good one that a lot of people are unaware of, but it's a credit that's available to you if you have eligible tuition expenses. You can claim this. And so you have these different credits that could be available here, and you've got your installments here as well. Okay, so if you pay your taxes as installments over the course of the year, that will be a credit. So that will net off of this amount here. Okay, so you have your total tax payable. Say it's like $10,000, but then you had maybe like $11,000 taken off from your taxes over the course of the year, and then maybe you paid some installments because you happen to make quite a bit of money above what you had taxes withheld from the prior year or something. All those things reduce to get you either a refund or a balance owing. Okay, so again, this is the 5-year comparative summary. It's a nice outline breaking down or just kind of grouping together the key elements of your personal tax return. I hope that was a helpful walkthrough to help you understand these different areas and how you can impact some of those areas. So the next time you get your personal tax return, take some time to look at these sections and just see what numbers are there, see how they compare year over year, see how they change, and then also become more familiar with what you can do to impact your own personal taxes. If you have any questions at all, feel free to reach out to us. We're happy to help.